Imagine retiring, and the day that you retire, the market enters a bear market. 20% of your portfolio is wiped out. That can be one of the most frightening things that can ever happen to a new retiree. Today, we're going to talk about how real people survived that situation and what they did that made all the difference.
Hello and welcome to this week's episode of The Capitalist Investor. People get upset that we don't use our nicknames anymore, so Diamond Hands D coming at you.
Yeah, Tony the Tiger over here.
Let's add in that sound. So this week we're going to talk about retiring into bear markets. So, like you alluded to in the intro there, it's the number one thing that's going to break your financial plan. So, being prepared for it beforehand is going to be obviously important. And we'll walk through a couple scenarios of kind of, real life scenarios of what people have done and how you guys can learn from them.
Right. So, I mean, if you're still working, it's not a problem, right? Because you're still saving, your dollar cost averaging in, and you got time on your side. But if you retire, you're done working, you're done saving, you're done earning, and you're spending. Right. And the biggest detriment to any retirement plan is spending money from a portfolio that is depressed, down, right? So that's the one thing, right? And then it's happened before. It's been a while since it has. But, 2000, people walking into the dot-com crash, 2007, the financial crisis, and then 2022, faced the worst bond and stock combination in decades. They were both down. Mm-hmm. The one thing I will say, though, is there are bear markets that are fundamentally created, and then there are bear markets that are policy created, right? Such as like a policy would be like the tariff board, right? Roll that thing out and the market crashes 20% within a week or a week and a half, right? Yep. But the market rebounded within 3 to 4 months. A true bear market that is fundamentally broken, like with high unemployment, low economic data, like GDP's negative, like there's like people are losing their jobs. They don't, like stuff like that. Those are more of the, maybe 12 to up to 18 month correction to get back to even is what I'll call it, right? Because something needs to be fixed, whether they start lowering interest rates to stimulate growth, all of that stuff. This is one big, huge oiled machine. And to fix a fundamental problem can take a lot of, take some time.
Yep, so, for sure.
But the biggest things is, we talked about the historic side, and the psychological dimension nobody plans for is, all right, like they start becoming, they're either going to like start selling because they're panicking, they're going to change their strategy, or they're going to alter their lifestyle. And to be honest, most people don't do the latter. I'll be like, hey, if we have all this stuff planned in your financial plan, if there is a problem, maybe you skip a vacation, right? If we have a vacation budget built in, but we haven't had to experience that in quite some time. Yep. So the biggest things I say, sell, or hey, maybe we should get more conservative or whatever. So like, we'll talk about those coming in to the next part. So let's talk about like 3 stories, D, of what I just painted. So,
yeah. So, story 1, we'll talk about someone retired in January of 2022. So Tony alluded to it there. That was the first time since, I believe, the Great Depression that both the stock market and bond market were both down more than 10%. Mm-hmm. So this person retired in 22 with $900,000 saved. By June, that portfolio was down to $680,000, so a 24% drop. They sold everything at the bottom, basically, locking in the losses. And by the time she felt comfortable re-entering the market, the stock market had already significantly corrected back to the upside. So, basically the lesson learned there is, moving into, making huge plays, right? Selling everything and getting into cash can really be counterproductive
Dude,
to
this
what you want to do.
This is the worst behavioral finance move you can make.
Yeah.
Because you are late getting out because you're like, oh my God, I lost 10% already. I need out. So you sell low, right? And then you're so scared and waiting for it to uptick, like you're missing the upside too, right? So you're abandoning, like staying in the market, right? You're trying to time the market. You're going to be late getting out because you already lost money, and you're going to be late because you're too scared to get back in.
Absolutely.
That's story number one. Story number two. This is more of a success story. It's like creating a bucket system, and typically, the bucket system, that's why we own bonds, right? But now we painted the picture in 2022. Guess what? Stocks and bonds can also go down simultaneously. So let's keep that in mind. So I mentioned it earlier that, a policy bear market could be 3-4 months. A fundamental problem can be up to a year and a half, maybe longer, right? So the solution to this, creating the bucket, is fine. Have your stocks and have your bonds, but having your budget dialed in, your lifestyle. That's what I'm talking. You got your Social Security, that'll continue to come. Maybe you got a pension, maybe you're getting income from an annuity or something like that. You have all these guaranteed. So the delta is coming from your portfolio. Why don't we, like right now is not a terrible time to be in money markets, not your checking account or savings account. We can put the money there. It's just going to earn pennies on the dollar.
Right.
But we can find money markets that are paying 2, 3, maybe up to 4% that are liquid. I know that those exist at Schwab. There's certain mutual funds that we use to capture that, right? They're more liquid than CDs and things like that, and we can have the money very quickly. So having, up to maybe 18 months of your delta is what I called it, right? Your spending from your Schwab or from your retirement accounts is what we need to just have on the side. It's going up very slow. If the market's up 20% and you're getting 3%, you're going to be upset, but we are setting ourselves up so that we don't make your plan worse. So having 18 months of living expenses. So if that means, hey, I'm taking out $3,000, I'm taking out $3,000 a month, that's 36 grand times 1.5 years. So we're going to be looking at nearly 50 grand. Right? 50 grand is just hanging out, and let everything else do what it's doing.
Yep, absolutely.
Right? And then we don't touch it until there's a true breakdown in the market.
Yep. So scenario 3, and we're gonna. I got a bunch of points there, so we'll hit them after scenario 3. The flexible spender. So Tony mentioned, maybe. Skipping some things if the market turns a bad way. So scenario 3, someone retired in 2022 again, $550,000, and immediately faced a downturn in the market combined with 8% inflation. So didn't mention that in the first scenario.
Zoinks.
Yeah. So again, there is heavy psychological issues at play here. But rather than selling everything, she took a part-time consulting role for 18 months, earning just $22,000 per year, which covered most of her initial expenses. This is also a great scenario if someone really wants to retire but is kind of on the borderline of their plan, picking up a part-time job early in retirement. Even with a small amount of income, that can really reduce pressures on your portfolio. Tony just outlined, if you're spending $3,000 a month, if you're earning an extra $20,000 over that time period, it's an extra $20,000 is you don't have to pull out of your portfolio.
Yeah. The downside on that is you just, like you got to look at it as not a failure.
Yep.
Right. And then you're, maybe this, because we're looking at 22 grand a year, this is a part-time job. Right. So, like you're not sacrificing all of your time. It's probably something on the last resort, something you do not want to do. Right. But depending on the severity of, how depressed the stocks are and things like that, it's a solution. It's not the solution. Right.
Yeah. So partial retirement is not a failure. it's actually one of the most effective tools out there to either save a plan during a downturn or kind of get you into that full retirement mode. So definitely something to think about there.
Yep. All right. So again, the playbook here is, how do we actually do this if you're retired into a down market? So first of all, don't sell your equities to fund your living expenses. We talked about that. You want to exhaust cash and short-term bonds so that you're not touching and locking in losses. So there was a stat that we always did in our educational class that, they took a 25-year period. I think it was from like 1995 to like 2000 or 2019 or something like that. If you missed the 5 biggest days in the market, your annual, if you stayed invested, you earned roughly a 7% rate of return on an annualized basis, and it's probably a little bit higher than that. If you missed the 5 biggest days, your annualized rate of return went down to 5.5%. It was almost like a 1.5% difference. And the silver lining or the double-edged sword of this is that the best days in the market typically come after the worst days. There, you got that rebound
within
thing.
2 weeks.
Yeah, it's crazy. So I just did a really quick kind of math. So if you had, like say you're still, working, you had $250,000 in your 401k, and we got this 25-year timeline, right? At 7%, $250,000 without even adding another dollar, just extended growth of the portfolio. 7% on 250 is roughly $1.35 million. At 5.5%, it's $950,000. The difference is roughly $400,000. That's a lot of money for panicking.
Right.
Right. So we have to be aware. History has been on our side where the market has rebounded. So being prepared for the rebound and the duration of the rebound is the biggest takeaway.
Yep, for sure. And part of that is rebalancing your portfolio versus just, selling a bunch of stuff and sitting in cash. So that goes into right what Tony was talking about there. So it can even be an opportunity, right?
But again, I'm going to play the other side of the table is like, Tony, I don't want to sell my bonds because they're down the least to put it in stuff that keeps on falling, right? So people are going to be scared to rebalance.
Right. But
rebalancing is part of the plan. It's part of the plan saying, hey, from day one, my allocation is a 70-30, stock to bond mix. Well, if it goes to 60-40, you got to take that 10% and put it back into stocks for this to work, because it's, getting off the script is another behavioral finance problem.
Yep, absolutely. And it works the other way too, right? Just a quick aside, if the market goes up 10% and you're, 80-20, and you're just going to let it ride, you're kind of getting greedy, and you can get bitten on the other side if there's a market downturn.
Great point, D.
Yep.
Great point.
So step 3, treat the downturn as a tax planning opportunity. I know next week we'll be talking about Roths again. So, Roth conversions work great in down markets, right? Yeah. You do the conversion with stock at a low point, get it into a tax advantaged account, and then watch it grow, and all that upside is tax free.
Yep. We talked about, flex spending, delaying, vacations, things like that. And then another point would be historical durations, right? When you retire, we do not buy a mattress, slit a slit in it, and start shoving our money into it, right? You probably have another 20 to 30 year time frame. We can get less aggressive, but we don't need to go completely cash, right? Because you're not going to keep up with inflation.
Right.
That's the whole key. The stock market has outpaced inflation. That's why we are involved in it.
Right.
So you can't just you just can't go complete conservative mode, right? And then another side step here is, maybe this is a step 6, is that use some of your alternative investments. And I'll just say, like, an alternative investment to me for this situation would be, if you have an annuity, specifically like the fixed index stuff, the stuff that can't lose money. Especially when you have an upturn, you lock in gains. So if you have an accumulation annuity, the ones that are growing, like a bond, somewhere in between a bond and a stock, you can access a 10% penalty free. Right.
Yep.
Use that because those aren't going to be depressed because the floor is always zero.
Yep, for sure.
So let's take advantage of those 10% penalty free withdrawals. Or if we have an income annuity and we haven't turned it on yet, let's turn that on to, sidestep some of the, dipping into the accounts if we don't have a cash reserve set up.
Yep, absolutely. And I've had, a quick point on that. I've had that conversation recently with some of my clients. Maybe they're taking withdrawals from their investment account. They have an annuity, an income annuity that's been cooking for a while. And, basically the play is, don't really need to do that now. The market's kind of sustaining, our withdrawal rate. If there's a market downturn, we'll turn that off and we'll switch to the annuity.
Yep. All right. So the takeaways, again, sequence of returns, the market goes up and the market goes down. I think we've been spoiled over the last several years, when the market's rolling over 3-4%, I get some panic calls. We haven't seen an inner year, over 10 this year yet,
right.
And the average is 13. In an election year, it's even higher. I continue to say that in different episodes. So, that's one thing. The bucket strategy, flex spending, part-time work, those are other items. And, the biggest risk is of a bear market isn't maybe the downward part of your portfolio, but it's how you react, the emotional side of it. And again, we have solutions for this. It's, we can find something that's cash. It's not going to be fun. It's not going to be sexy. It's going to play that in that 3 to 4% range, but it's there for a purpose, right? And that's why we build financial plans. Have your advisor build a plan where, hey, Tony, we're going to put in something that is more conservative, but it's for this scenario. That we do build these scenarios, bear markets, right? Entering retirement. We do it on an aggressive part where we build the plan, and the day you retire is the day you lose 20%. Right. It could be that drastic, not in one day, but like over the course of a month of retiring, that's a big freak out moment. Well, let's paint the scenario for that, right? So that we can you survive that, right?
Yep, absolutely. And I think I'll sum up with, prepare before it happens. You're always going to be better off having a plan and preparing for a downturn and making sure your portfolio is in the right spot for that versus reacting to a bad situation. So make sure you're prepared and you have a solid strategy down. So thanks for listening this week, guys. If you have any questions or comments, hit us up at info@swpconnect.com, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.